Hello everyone, I hope you guys are doing great and your studies are going in full swing. In today's video, we will try to cover the chapter on risk management in your AFM, particularly in that the concept of value at risk, that is VaR. Now this is the essence of the chapter, to be honest. So majority of the times when a question comes from risk management, at least on the numerical side, it is almost always on VaR. So if you get mastery over that concept, along with all the sums which are relevant from the study material, as well as the two tricky exam questions that have come, we will be discussing all of them today. So let's get started. So what do you mean by value at risk? Now, value at risk or VaR is a measure of financial risk to find that what is the maximum possible loss that an investment can possibly suffer in a stated time frame. Like for example, when I buy, let us say, shares worth 1 crore, so people would say that what is the maximum loss that you can be. So we are saying that, well, hold on, we need to figure out what is the time horizon. Theoretically, one can say that because it is an equity investment, the value can come down to absolutely 0 rupees, and as a result you might lose the entire 1 crore. However, if your time horizon is 1 day, is it likely that you will lose out the entire 1 crore in a single day? Well, it is quite unlikely. And as a result, you will try to find the maximum possible loss considering the time horizon. So the first essential element that you look in VaR is the time horizon, the time period. Can be 1 day, can be 7 days, can be 4 days, etc. Second is you will look at the standard deviation. Now there may be certain stocks which may be inherently much more volatile, and certain stocks like Colgate, for example, may be much more stable. Whereas when you look at someone like let us say a real estate company, they may be a much more volatile stock. So we will say that okay, in 1 day Colgate may also deviate, or maybe a real estate company can also deviate, but what is the average deviation? So we will calculate what is called as the standard deviation. Typically this is calculated on a daily basis. In your portfolio, usually the standard deviation you calculate is a annual standard deviation. Over here you will say that, well, on average how much is the deviation on a daily basis. The formula for standard deviation is the same that you study in portfolio. Let us say if there are no probabilities, then under the root summation of x minus x bar the whole square divided by n, or if there are probabilities, then under the root summation of probability p into x minus x bar the whole squared. So you will try to calculate the daily standard deviation. So we will say that okay, let us say the average daily standard deviation is 2%, and we want to find the maximum value in the worst case that you can lose in a particular day. So daily standard deviation 2%, and the value the time horizon, let us say, is a day. Now you need to figure out that standard deviation is actually an average deviation. Loosely speaking, it is an average deviation, not the maximum possible deviation. So we will say that, well, these price movements follow a particular pattern, and the pattern over here is a normal distribution, the bell curve pattern, where we would say that, well, the distributions on an average would have 2%, but there can be a higher amount of deviation or a lower amount of deviation as well. So we'll say that, well, what is the normal distribution value which covers, let us say, 99% of the deviation. Now you can have various types of VaR, the 90% VaR, the 95% VaR, the 99% VaR, which is the most popular for the institute, or in practice you even have a 99.99% VaR. So over here, let us say we focus on the 99% VaR. Now for this you need to have a little bit of knowledge of the normal distribution tables. If you understand that, well and good. If not, you can just remember the numbers. In any case, those will be given to you in the question, or otherwise you can just remember a number. So you will have a Z value, a normal distribution value. So normal distribution value at the center is the mean, and we are saying that, well, if on the left side there's a 50% value, on the right side there's 50% of the observations. So if I want to cover 99% of the observations, so probably 1% can be an outlier. So if I want to cover 99% of the observations, what will be my Z value from the normal distribution table? So if you look at the table, and if you know how to read the table, which is a separate discussion altogether, but if you read the normal distribution table, then at around 2.33, we will say that 99% of the observations are covered. So we will say that, well, if 99% of the observations are getting covered and 1% is, let us say, an outlier, then at a 99% confidence level, we are saying that okay, 2% is the average deviation. I don't want the average, I want the VaR, which value at risk, which covers 99% of the observation. So at that is around 2.33 times the standard deviation. We will say, well, you know what, the average deviation is 2% into 2.33. That will give you the deviation or that will give you the value. You first find the daily standard deviation in percentage, you convert that into rupees. So let us say we had a 1 crore portfolio, 1 crore into 2% will come to 2 lakhs. So 2 lakhs is the deviation, and 2 lakhs of deviation into, let us say, 2.33. For example, if you calculate 2 lakhs into 2.33, whatever that value comes, let's say that comes to 4,66,000 is your deviation on the worst possible case, where 99% of the value of the observations are covered, into we have a root of days. So when you look at the formula over here for value at risk, there are 3 essential ingredients. This is the value at risk calculated using the statistical, or also called as the parametric method, which is a method which the institute usually uses. So over here we would say that the value at risk, or VaR, is the daily standard deviation in rupees. In our example, that is 1 crore into 2%, that is equal to 2 lakhs, into the Z value, usually at the 99% confidence interval, that is around 2.33. At other confidence intervals, we have given you a few data points, you can just refer that, but the institute usually takes 99% only. So that will give you 4,66,000, but that is a deviation on a single day. What if you want to find the deviation over more than 1 day? Then what? Well, you multiply this by something called as root of days. Now this is where students usually get confused, that why are we taking root of days? Well, intuitively, it is because when you calculate the standard deviation in the standard deviation formula, loosely speaking, okay, this is just for your general understanding, in the denominator, when you take the standard deviation, like the 2% that you calculate, in that standard deviation you have implicitly taken in the denominator n. Well, but in the answer, the effect of that is not directly n, it is the root of n which has gone in this calculation, and hence we said that, okay, if this deviation took, let us say, n, in my final working I would take the root of n if I want to multiply it by the number of days. So on an absolute level, if I want to find the value at risk in rupees, loosely speaking, I will multiply this by the root of days. So if I want to find the deviation over 4 days, then the root of 4 is 2, over 9 days the root of 9 is 3, and so on. But generally institute usually asks you for 1 day. The 2 exam questions that have come have taken the deviation for 4 days. So over here, if I multiply this into the root of 1, that will come to around 4.66, which means if I have 4,66,000, please pay attention on the application of VaR, on why is it important. And in practice, a lot of exchanges use VaR as the base for the purpose of determining the margin in futures. If you remember futures, in futures you have to determine the initial margin. Most of the exchanges actually take the 99.9% VaR, but nevertheless, even if they were to take the 99% VaR, that is the deposit they will ask from you. So today, if I have 4,66,000 rupees in my bank account, and I think that I will have that for a day. Now, if I invest in the cash market, mind you, if I invest in the cash, that is a spot market, I can make an investment of 4,66,000 only, and it might go up, go down, and it will give me a gain. However, if I want to take an exposure in the futures market where I'm okay losing the entire 4,66,000, we'll say that, well, you know what, in 1 day the value can become 0. Theoretically, yes, but it is quite unlikely. So based on the past normal distribution data, based on the deviations, etc., we believe that if, let us say, your portfolio, or if you take a futures position of 1 crore rupees, and let us say you deposit 4,66,000 as margin. So in the worst case, now on an average the deviation is around 2%, but if I take for example in the worst possible case as well, we do believe that 99% of the chances at 4,66,000, even if my entire capital is wiped off, that is my maximum value at risk on a single day. Which means, if, I mean, now I'm painting the worst possible pessimistic picture, but it is quite possible that the share actually performs better. Now, if it does well, I would have earlier in the spot market gained only on my spot investment of 466. In the futures market, I can actually take a position of 1 crore rupees. So if the stock goes up, for example, 5% in a day, and you've seen a lot of companies go up 5% in a day, if I had invested the 4,66,000 in that share for a single day, I would have just earned 466 into 5%, that is equal to 23,300, which is still a good amount, but that's 23,300 in a single day. On the other hand, if I had taken a futures position, for example, for a single day, by depositing or investing 4,66,000, I can take a futures position of 1 crore. I'm just explaining you the practical application. And on that, if I took a long position, and, or that is a buy position, and the price went up, I will make 1 crore into 5%, that is a 5 lakh rupee return in a single day over a 4,66,000 deposit. Now this might sound to be very attractive and we will say chalo padhai chhodte hai and we will go to do this, but it is double edged. You can always say that it goes down 5%, in which case it will become quite lethal. So over here, when we look at these situations, VaR is a risk measure. When you do FRM, for example, a lot of preparation is done behind VaR. So VaR is a value at risk. In the exam, you need to calculate and interpret it. So how will you calculate it? Well, VaR is calculated in rupees, not in percentage. So you calculate the daily standard deviation in rupees, that is a portfolio size, into the standard deviation percentage, into the Z value. Typically the Z value comes from the normal distribution table. Usually at 99%, you will take the 2.33 value into the root of days, because in the standard deviation calculation, we have actually taken root of n implicitly in the working. So institute over here takes the root of days on a simplistic level without unnecessarily complicating it. So this is how you will apply for VaR. There are a couple of other methods like historic method or a Monte Carlo simulation. I would not really read too much into that. Historical method would just look at the number of days. For example, if it is you're trying to find a value at risk, you will take the last 100 days, and in that the highest deviation, you will say highest deviation on which date has happened, that is a maximum value at risk. Or a Monte Carlo simulation, you will feed the data into the computer and run various loops and try to find that what is the maximum deviation which is possible. But again, the institute has not discussed on these lines. They have discussed the statistical or the parametric method. So we will discuss 3 sums on this. One of them is your study material question, where there is some application of portfolio as well. The other 2 questions are your past exam and interesting questions. So hang on. Hopefully, if you do this properly, you should by and large be able to manage VaR and risk management in your exam, at least on the numerical side. Okay, so let us go to risk management over here. Let us say we go to question number 1. Consider a portfolio consisting of 2 crores investment in shares of XYZ and 2 crores investment in shares of ABC. So that is 50-50 weight. The daily standard deviation of both the shares is 1% and the coefficient of correlation between them is 0.3. You are required to determine the 10-day 99% value at risk for the portfolio. So you have the daily standard deviation in percentage. However, that is for the individual securities. Remember, you need to find the VaR for the portfolio, not for the individual shares, and hence you will try to find the standard deviation of the portfolio. Remember, the standard deviation of the portfolio is calculated using the portfolio in the portfolio chapter. That is standard deviation of, let us say, X and A will be the weight squared X into the standard deviation squared of X plus the weight squared A into the standard deviation squared of A plus 2 into weight of X, weight of A into standard deviation X into standard deviation A into the correlation. So if I go to see, this is a formula that we will use for the purpose of finding the standard deviation, applying 1% and 1% as the respective standard deviation and 50-50, 0.5 as the weights and 0.3 as the correlation. As you can see over here, we will find root of 0.65, that is 0.8062%, that is approximately 0.8% to be the portfolio standard deviation. See over here, the securities are not fully correlated and hence the portfolio standard deviation is probably lesser than 1%. So that is around 0.81 or 0.8062%. Now if I want to find the value at risk at 99% confidence, so your VaR will be, your total portfolio is 4 crores. Now 4 crores into 0.8062% will come to 3,22,480. Now this is your average standard deviation in rupees on a single day into the Z value. The maximum standard deviation you can say is 2.33 times of that, the Z value, because 3,22 is the average deviation. We are saying on the worst case, what will be that be? So that is 2.33 times of that, assuming the returns or the risk over here is following a normal distribution pattern, into the root of 10. So if I take the root of 10, because 10 is the days for which we have to look at this, this is coming to let us say 3.16. So approximately 322,480 into 2.33 into 3.16, approximately 23,74,000. So this is 23,74,000 or 75,000. That is your value at risk on a 10-day period. If you have a portfolio of 4 crores, your value at risk essentially over a 10-day horizon is 23,75,000 approximately. Now this is a fairly easy and a scoring question, but what comes in the exam, let's say in the November 20 paper or also in the May 23 paper, is a slightly different setup. So let us review this once. On Tuesday morning, before the opening of the capital market, an investor, while going through his bank statement, has observed that an amount of 7 lakhs is lying in his bank account. So when is he seeing that? On Tuesday morning, this amount is available for use from Tuesday till Friday. The bank requires a minimum balance of 1,000 all the time, which means well, I will need, if all goes south, I still need to have 1000 in my bank account. As of now, I today have 7 lakh. 1000 I need minimum at all points of time, and hence the value with which I can play around is 6,99,000. I can play around with 6,99,000 of value. The investor decides to make the maximum possible investment. Well, we'll say maximum possible investment, you invest 6,99,000 in the spot. Okay, but maximum investment in such a way where the value at risk should not exceed the balance lying in his bank account. It is not saying that the investment should not exceed the balance lying in the bank account. The value at risk, the VaR, should not exceed that. The standard deviation of the market price of the security is 1.5% per day, and the confidence level is 99%. So this is the standard normal probability is given. So this is like the normal distribution table, in which case we say at what level does 0.99 get covered. So when I look at 2.3 and then 0.03, that is Z is equal to 2.33. You are required to determine the maximum possible investment. So you have been in this question given the VaR. In the last question, 23,74,000 or 75,000, we calculated was the VaR. In this case, we have been told that, well, 6,99,000 is a value that you can put at risk. But for that, you'll have to take a position of how much. Well, let us say that is X into at Z of 2.33 for a period of 4 days. The question very clearly tells you that it is available from Tuesday till Friday, and hence this is for a 4-day period. So this is into, let us say, the root of 4. So if you do this working, this is what? X into 2.33. So if I take this 6,99,000 divided by 2.33 and divided by 2, so this comes to probably just a second. So if you look at this, 6,99,000, that is a value at risk, divided by, so therefore X is equal to what? Over here, actually when we go to see your standard deviation, this is your standard deviation. What you will get is your standard deviation. So one option is you can take the amount that you invest as X, and X into 1.5% will be, or otherwise you take the standard deviation, then you'll get the standard deviation in rupees. So if your amount invested, let us say, is taken to be X, then rupees X into 0.015, that is 1.5%. This will give you the standard deviation in rupees. So over here, if you go to see 6,99,000 and divided by 0.015 into 2.33 into 2, and this is approximately 0.0699. So your X comes to 1 crore. Now if you directly find X, well, your X, if you find directly, then you will have a slightly different number, but that is a standard deviation in rupees. That standard deviation in rupees, well, you want to find the portfolio position that you can take. Well, we will have to then say that X is equal to the amount invested in the portfolio into 1.5%, and hence you will again come back to the same number, that is 1 crore. So over here you will have 1 crore, which is the investment that can be possibly be made. Now this takes care of question number 2. Question number 3 is a much more tricky, a controversial and a detailed. So a lot of these questions have an overlap with portfolio. So question 3, Institute tried to test some portfolio concepts along with the VaR concepts in the May 23 paper. So Mr. Bull is a rational risk taker. He takes position in a single stock for 4 days in a week. He does not take the position on Friday to avoid the weekend effect and takes position only for 4 days in a week, that is Monday to Thursday. So basically he is taking a position for 4 days. End of the day, he transfers the amount on Monday morning and withdraws the balance on Friday morning. So again, whatever you are investing is for a 4-day period. He desires to make a maximum investment where VaR should not exceed the balance lying in his bank account. It is exactly the same language as the earlier question. Like in the last question it was 6,99,000. Similar is the case over here. Here you just have a couple of layers of additional complexity. Now the position by his manager as per the standing instructions. Now this is a very interesting thing. What does the question tell you? The position by his manager as per the standing instructions is taken on the free balance lying in the morning on each Monday. So who is taking the position? Be mindful of that. Is Mr. Bull taking the position or is his manager taking the position? As per the standing instructions, it is a manager who is taking the position, and the manager is taking the positions based on the free balance lying in the bank account. So manager will look at, so he has his assistant, the portfolio manager, who will look at the amount in the bank account, and as per the standing instructions of Mr. Bull, he will take the position based on that. Now that is an important piece of information to note over here. Now on Monday morning, before opening of the capital market, he transferred an amount of 11 crore to his bank account. So Mr. Bull transferred that. So his manager would in all likelihood see that 11 crores and he will possibly take a position based on that. A fixed deposit also matured. Now this is the tricky part. A fixed deposit also matured on Monday. The maturity amount of 63 lakh 42,560 was also credited to the account on the morning of Monday. Now this is already there on Monday morning, and hence it is a part of your free balance in your account. However, Mr. Bull received the intimation of the same in the evening. The bank needs a minimum of 1,000 rupees at all the time. See, Mr. Bull is receiving the intimation in the evening. So now a lot of students have this doubt that should you consider 63 lakhs? While considering the calculations, the answer is yes, because the position is not taken by Mr. Bull, it is taken by the manager of Mr. Bull as per his standing instructions, and the manager does not call up Mr. Bull to ask him how much is the position taken. The manager will take the position based on the amount lying in the free balance lying in the bank. So the value of Z score at the required confidence level at 99% is 2.33. Now this is the Z score value. The other information, so the Z value is given. The other information in regard to stock X and Y which are under consideration for this week are as under. So the manager can take a position either in X or in Y. The other information with respect to stock X and Y which are under consideration is as under. So you have been given the return of X and return of Y and also the probabilities. So basically the question does not essentially tell you what is the standard deviation of X, what is the standard deviation of Y. If you look at question number 1 or question number 2, in both cases you were told that the standard deviation of the security is either 1% or 1.5% as the case may be. However, in this question it remains silent, but then we know how to calculate the standard deviation hopefully using the portfolio management chapter. So when you look at the portfolio management chapter, standard deviation can be calculated as summation of P into X minus X bar the whole squared, or summation of P into Y minus Y bar the whole squared. So basically what we will try to do is we will try to find the X bar, we will try to find the Y bar over here. So you can take the probability based weighted average. So if I just showcase that solution, it is also printed over there, but if I showcase that solution like we typically do, so summation of X and then you will get 1.3 for the purpose of deviation. X bar is 8, Y bar is also 8. So that is giving you the same average return, but when I calculate the standard deviation, that is calculated in the same way like you do in portfolio, like you take P into X minus X bar the whole squared. So for example, P that is 0.1 into X that is 6 minus 8 the whole squared. 6 minus 8 is 2, negative squared that is 4. 4 into 0.1 will come to 0.4 and so on for each of these cases. So you will take 1.14% and 2.19%. So the institute over here also tests your understanding of the portfolio chapter. So basically let us say this is a question which tells you that the standard deviation of X is 1.14% and the standard deviation of Y is 2.19%. So if you take that understanding into the base and let us say forget X bar and Y bar, that X bar and Y bar is needed to find the standard deviation X and standard deviation Y. Let's say one of this is 1.14% and one of this is 2.19%, in which case once you find this, your working is going to be exactly similar to what you did in question number 2. You are required to recommend a single stock where the maximum investment can be made. Now how much is the VaR that you can manage? Well, that is 11 crores plus over here. So if I take the full numbers, 11 crores which is there in the bank account plus fixed deposit. Should you take the fixed deposit? Answer is yes, because the manager is acting as per the standing instructions and 1000 has to be kept. So if you look at this, this is 11 crore 63 lakh 41,560. So this is your VaR, but this VaR 1163 41,560 should equal, let us say, the amount invested. So let us say that is X crores into the daily standard deviation which we have found as 1.14% into 2.33 into the root of 4. Again you are taking the position from Monday to let us say Thursday for 4 days as the question tells you, and hence this will be calculated accordingly. So this is, let us say, 1.14 and this is I think 2.19. So if I look at one of them, let us say X, I will say 11 crore 40, how much is that? 11 crore 63 lakh 41,560 equals, let the amount invested be X into 0.0114, it is 1.14%, okay, into 2.33 into the root of 4. And if you go to see and if you solve this, you will get X. Now the institute may have taken over here, ideally this should be considering the root of 4. So for 4 days, so this will be divided by root of 4 and you will get the answer. But if you don't want to do it the way it is done in the institute table, we have also solved it, let us say, in a horizontal manner. So this is 1163 41,560 divided by 0.0114 divided by 2.33 divided by 2, and you have this huge number which is approximately 219 crores. So over here you can see 219 crores is the maximum position that can be taken in stock X. A similar calculation you can do for Y. 11.63 equals Y into 0.0219 probably into 2.33 into root of 4, and you will get an answer. So what is the question asking you? You are required to recommend a single stock where the maximum investment can be made. So the maximum investment can possibly be made in stock X, and that is a single stock you should take. So I hope this video has been helpful. If you want to be updated with similar such interesting videos, please do like, share and subscribe, and also please share your comments in the comment section. Till the next video, keep studying hard. Good luck and bye bye.